Hello everyone, welcome to the Capital Intelligence channel. Look, if you're serious about finance and investing, you already know the markets are always evolving. But what you might not realize is just how fundamentally the actual machinery of trading has transformed behind the scenes. Today, we're bringing you a comprehensive explainer on the invisible, high-speed forces that are literally governing modern capital markets. We're going to bypass all the usual noise and just focus on the absolute essential high-value insights regarding algorithms, high-frequency trading, and AI. Let's get right into it.
Okay, let's kick things off with a statistic that pretty much shatters the traditional illusion of Wall Street. When you picture a stock exchange, right, you probably imagine this chaotic trading floor packed with shouting brokers. Well, the reality? Human traders currently execute only about 10% of modern trades. 10%! The other 90% is entirely automated. The human investor has largely been swapped out for machines that are designed to maximize profit at speeds we literally can't even comprehend.
So to really grasp this landscape, we've got to start with the absolute foundation, and that's algorithmic trading. Now, this isn't just basic automation, okay? We're talking about complex computer programs built to automatically execute trades based on a really strict, predefined set of instructions. These algorithms constantly scan the financial markets and they execute trades the exact millisecond those specific conditions, things like a specific price target, exact timing, or trading volume are met. It completely strips out human emotion and manual intervention. It replaces human intuition with cold, incredibly efficient code.
Now, think about how these algorithms actually generate the signals to trade. A super classic example here is a strategy called mean reversion. Basically, it's a statistical approach that just assumes an asset's price will eventually bounce back to its historical average over time. So, say a stock like Microsoft usually trades around $300, but suddenly dips to $285 for no obvious reason. The algorithm instantly spots this temporary price discrepancy. It automatically buys up that undervalued asset with the strict mathematical expectation that the price is going to revert right back to its mean.
But hey, not all algorithms are out there hunting for price discrepancies. Some are built purely for execution. Enter VWAP and TWAP. When massive institutional investors or big broker-dealers need to move millions of shares, they can't just dump that onto the market all at once, right? That would cause crazy price swings. So instead, they use these execution algorithms to quietly slice a massive order into much smaller chunks. VWAP splits the order based on historical daily trading volume, while TWAP just splits it evenly over a set time period. It essentially allows the really big players to invisibly fill huge orders while keeping their market impact to an absolute minimum.
All right, moving on to Section 1, the need for speed, high-frequency trading.
To understand how this basic algorithmic execution turns into an all-out race for absolute speed, we really have to look at where this high-frequency ecosystem actually lives. The modern structure is honestly incredibly precise. Starting on the left, the trader receives market data feeds, processes them, and runs their trading strategy along with some initial risk management. Then, they pass those orders to the broker or dealer right in the middle. The broker handles internal risk checks and smart order routing, basically figuring out the absolute fastest and cheapest path for that trade. And finally, on the right, the order hits the trading venue, or the exchange itself, where the actual matching of bids and asks happens. Optimizing every single inch of this exact pipeline, that is the difference between massive profits and total loss.
And to win in that fiercely competitive ecosystem, software alone just doesn't cut it anymore. High-frequency trading firms are literally hardwiring their algorithms straight into custom computer chips using FPGA technology. This hardware acceleration pushes their end-to-end processing speeds down to 1 microsecond. Let's just put that into perspective for a second. That is 1/1,000,000th of a second. We are talking up to 2 orders of magnitude faster than standard software. Down at this level, these firms are micro-profitizing. They're making tiny fractions of a cent, but they're doing it on millions of trades every single day. Which brings us to Section 2, the AI trading revolution. Now, speed is only half the equation in today's markets. We're actually transitioning right now from an era of pure speed and rigid rules-based automation into an era of truly adaptive intelligence. The most modern quantitative hedge funds and prop trading houses, they are heavily deploying deep learning and neural networks. Specifically, things like sequential learners, long short-term memory networks, or LSTMs. See, unlike older time series models that just assume markets act in a straight line, LSTMs can actually adapt to really complex non-linear dependencies and dynamic lag effects. They aren't just following static rules, they are dynamically learning from massive datasets to predict future close prices and market direction with, honestly, eerie accuracy.
And to feed these hungry neural networks, firms are ingesting just unbelievable amounts of what we call alternative data. We are way past just looking at quarterly earnings reports here. These AI platforms are processing unstructured data in real time. I mean, they're scraping social media buzz, they're analyzing satellite imagery of retail parking lots, tracking blockchain transactions, running natural language processing on breaking news articles as they drop, and even analyzing global point-of-sale data. It's wild. Systems like JP Morgan's LOXM AI use this vast, rapid-fire intelligence to optimize trade execution and significantly reduce slippage.
That takes us to Section 3, the dark side, risks and manipulation. Integrating systems that are this fast and this autonomous naturally comes with some serious fragility. And as serious investors, it is absolutely vital we look objectively at the systemic risks they pose. One of the biggest vulnerabilities is how these systems behave depending on the economic weather. Under normal market conditions, HFT algorithms actually provide immense value. They're constantly replenishing orders and providing deep market liquidity. But during an economic downturn or a sudden moment of extreme stress, those exact same algorithms are programmed to ruthlessly minimize risk. They'll simultaneously cancel orders and just completely withdraw from the market, which creates sudden, massive liquidity gaps at the exact moment the broader market needs stability the most.
So, if we look impartially at the total impact of high-frequency trading, it truly operates as a definitive double-edged sword. On the positive side, the tech actively creates narrower bid-ask spreads, lightning-fast order matching, and ample liquidity when you need to close positions quickly. But conversely, on the negative side, that exact same sophisticated technology enables predatory tactics like quote stuffing, it creates the underlying potential for cascading algorithmic sell-offs, and, as we just saw, it can result in the sudden and incredibly dangerous disappearance of liquidity.
The absolute ultimate historical example of this systemic risk is the 2010 flash crash. In a matter of literal minutes, the Dow Jones Industrial Average plummeted nearly 1,000 points. It erased about 9% of its entire value almost instantly. So what actually happened? Well, a rapid withdrawal of liquidity magnified some existing downward momentum that violently triggered automated stop-loss orders across the entire market, which then sparked a cascading, unstoppable wave of algorithmic selling. It completely overwhelmed our traditional market safeguards. It proved unequivocally that highly interconnected algorithms can spark dramatic market collapses from honestly relatively minor triggers.
Beyond just systemic fragility, though, the sheer speed of these algorithms allows for intentional, targeted market manipulation. Let's break down a highly illegal, really predatory tactic known as spoofing. Step 1. An algorithm places massive phantom orders that it has absolutely no intention of ever filling. Step 2. This huge influx creates a false signal of supply or demand, which tricks other algorithms and human traders into reacting. Step 3. The manipulator cancels those original orders in mere milliseconds. And finally, step 4, they instantly execute the opposite trade to profit off the artificial price movement they just manufactured. It's brilliant, but entirely illegal.
All right, our final section. Section 4, regulating the black box. This really brings us to a critical crossroads. How on earth do you police an ecosystem that operates in microseconds and is increasingly driven by artificial intelligence? Well, around the world, regulators have assembled a bit of a patchwork of responses to try and maintain market integrity. Over in the US, the Dodd-Frank Act explicitly targets and outlaws that practice of spoofing we just talked about. In Europe, MiFID II requires investment firms to notify authorities of algorithmic trading, they mandate really strict risk controls, and even require algorithmic kill switches just in case a system goes rogue. Meanwhile, the UK's market abuse regulation takes a more technology-agnostic approach, essentially just confirming that market manipulation is illegal regardless of whatever automated means you use to execute it.
But here is the fundamental legal flaw we are currently facing with all of this, the intent conundrum. To successfully prosecute market manipulation under current laws, regulators have to unequivocally prove that the trader acted with the direct intent, or at least recklessness, to defraud the market. Now, proving human intent is already incredibly difficult on a good day. Proving the intent of a pre-programmed algorithm, that is a whole different level of complex.
And that leaves us with an incredibly profound dilemma as we look toward the future of investing. Because remember, we are moving from strict algorithms to autonomous machine learning. So I want to leave you with this question to think about. If an artificial intelligence, motivated solely by its programmed goal to maximize profit, autonomously learns and executes manipulative tactics like spoofing without any direct human instruction, who's to blame? Is it the developer who wrote the code, the firm that deployed it, or the machine itself. It's a really sobering reality of the modern capital market, and one that regulators, and frankly, all of us as investors, are going to have to navigate in the years to come. Thank you so much for joining us on this explainer, and we will catch you next time.